What if I told you that trying to qualify for ACA subsidies and getting cheaper health insurance might actually end up costing you hundreds of thousands of dollars over your lifetime? At first, this might sound backwards because qualifying for those ACA subsidies actually helps you save money, but I'm about to show you why this might be a bad idea and why this common retirement advice could cost you big time. Hey there, my name is Jacob Duke, and I'm a certified financial planner and the owner of a retirement planning firm where we help people just like you plan smarter so you can retire better. Now, we're about to walk through a case study here in just a moment where I'm going to show you the actual trade-offs and how much you could lose if you do this wrong. But first, let's talk about why this is actually important. If you retire before 65 and before Medicare kicks in, one of your biggest questions will always be around health insurance. And one of those questions is going to be, hey, what options are available? Or should I wait until 65 so that I qualify? And perhaps the biggest question is going to be, how much is private insurance going to cost me? But thanks to the Affordable Care Act, if you keep your income low enough, you might qualify for significant subsidies that could reduce your premiums drastically. For example, a 62-year-old couple might only pay $300 to $400 a month for coverage for their premiums with the subsidies instead of $1,500 or more without the subsidies. Now, that's real money, and that's why many retirees design their entire withdrawal strategy around this, but here's the problem. In doing everything you can to keep your income as low as possible, what you're doing is you're missing out on the best opportunities you'll ever have to do Roth conversions. This period of time early in retirement is often called your gap years, and by not taking advantage of these gap years early on, you could end up paying the price later in the form of higher taxes, higher Medicare premiums through IRMA, and less control overall in terms of your income once RMDs begin. So let's take a look at an example to see how this might play out in real life. Right here, we've got Bob and Sue, and this is a hypothetical couple. They are 60 and 59. They just retired a couple months ago here earlier in 2025. So let's take a look really quickly at their scenario, and then I'm going to show you why maybe doing Roth conversions instead of trying to qualify for those subsidies could be the best thing for you. So let's look really quickly at their net worth. They've got about $3.2 million of a total net worth. About $600,000 of that is actually in their primary home, which is completely paid for. They've got $50,000 in the bank, and they have about $2.5 million of retirement savings between Bob and Sue's different IRAs there. And they also have a joint brokerage account, and that's going to be critical here in some of the decisions we'll be making. So that's their overall situation. Now, what are they trying to accomplish? Well, they just retired earlier this year, a couple months ago. They want to spend about $6,000 a month, maybe go on a vacation or so. They're putting about $15,000 down per year for that. And then I'm going to come back to this extra health premiums here in just a moment, but something you should know is right now what I'm assuming in this base plan is that they are going to actually be qualifying for the subsidies. So they're going to be paying $200 per month each for their private insurance because they're not going to have much income because they're going to be living on that brokerage account using capital gains and tax gain harvesting to pay basically no taxes this year, have no AGI. So that's why their premiums are going to be so low for their health insurance until 65. And then this jumps up once they are 65 and beyond, just as a projection, to where it includes Part B, a Medigap policy, and Part D, and this number for each of them at that point. So that's why this number is $2,400 each. We're going to change that here in just a moment by adding in the additional cost once we get to the Roth conversion scenario. Okay, so right now they have no income because they were retired, but once Social Security does kick in, Bob's going to get about $3,200 per month, and right now we're planning on taking that at 67, and then Sue will get about $2,800 per month at 67 as well. Obviously not saving any money, so right now let's take a look at their retirement situation and see, hey, can they retire? The answer is yes. And you can see that here. They're not going to run out of money. They're going to end up with more money at the end of life than they started with, most likely, because their spending is low relative to how much they have saved. So the purpose of this video is not really to analyze their retirement situation and, can they retire or not. We know that they can. Really, it's to analyze the ACA subsidies versus paying more for health insurance right now by doing those Roth conversions. So let's look really quickly at their cash flows to kind of show you like where they're at from a tax perspective. And you can see here's their expenses of $76,000. They've got the additional costs there for their travels, and they're paying no taxes. Why is that? Well, right now we're telling the system to take all of their income from their brokerage account, which currently has $400,000 in it, and a portion of that is obviously going to be capital gains, and those are going to be the long-term rate. So that's why no taxes are being paid here. If you're curious how long-term capital gain rates work, I've got a video down in the description that's going to be linked there to share more about that. So you can see how gains can be realized in any particular year if your income is low enough at that 0% rate. This is only possible whenever they're not taking Social Security, they don't have earned income, they don't have IRA distributions, they don't have a pension or anything else like that that would push them above those long-term capital gain brackets. So that's what's happening here. They're using all their portfolio from their brokerage account. They're not using their IRAs at this point. And you can see they're not paying any taxes for, I guess, what is that, almost 6 years, 5 years, almost 6 years. You can see that there until they get to 65. And that's whenever they would go into Medicare. And that's kind of the point, at least based on how they wanted to do this originally. They wanted to keep their income as low as possible, pay minimal taxes, and have no AGI really, so that they could qualify for those ACAs on their health insurance in the private market. So that's where they're at. Now, what this does is if we look here, we can see that their tax rate jumps. At this point, this is whenever all of their distributions would have to come from their IRAs because they've depleted all their after-tax accounts. And then again, it goes down right here in 2033, this 68 and 68, that's how old they would be by the end of this year. So they would turn 68 during this year, so partial year here. You can see their tax rate actually, I guess their total taxes paid get cut in half basically. The reason for that is because of how Social Security is actually taxed. And based on current legislation, 85% of Social Security benefits are subject to taxation. It could be less than that. It could be all the way down to 0% or none of your benefits being subject to taxation. It just depends on your other sources of income. And I've actually done videos on this showing you how you can calculate your taxes on your Social Security benefits to help you plan better. I'll have that video linked down in the description as well. So you can see their total tax paid actually go down here, and that's because of Social Security being taxed in a lesser amount. What you can see is we go here, so this is really not bad, and then boom, 2040, 75, that's whenever they have to begin taking money out of their accounts, out of their tax-deferred accounts, specifically because of RMDs, required minimum distributions. And what you can see is their plan distribution, assuming everything goes like it is, they're spending the amount of money that we've anticipated them spending here. We have a decent growth rate, so right now they're in a 60-40 portfolio, so 6-7% annualized returns is what's being actually built into this assumption. So I don't know if that's what they're going to get or not, but that's what's being built in. And with that, they have obviously multi-million dollars of tax-deferred accounts already. With that growth and taking minimal amount of money out of that because they're spending their brokerage account first, they're going to have really large RMDs beginning at 75 for both of them combined. And so you can see $225,000 is how much their year one RMD is going to be, and it's going to likely go up over time as well. So what this does is this immediately changes their tax situation. You can see a huge jump here. And so that's what I want to analyze really fast. So let's look and see what they can do to maybe reduce their overall taxes at this point, because this is going to become a big issue. We can actually see this here on this chart. We can see that they have no income tax issues right now at all. And then they go up slightly, just like I talked about, and then they come back down once Social Security is turned on. And that is that big jump there for RMDs. So you can see their lowest tax years, their gap years, are going to be right here between 60 and then 65-ish. So they've got about a 5-year window. If they want to do any tax planning or take advantage of any opportunities, now's the time to do it rather than maybe qualify for those subsidies. So let's look at this. What if, they did some different Roth conversions over this 5-year period? So what we're going to do is right now, no changes have been made. You can see again, we've got this here. And what I want to show you really fast actually is if we turn on this Medicare premium tax bracket, so IRMA surcharges, you can see once they do get to RMD age, it actually pushes them over that first level. And so you can see here, they're likely going to have to pay IRMA for the rest of their lives because their income is going to go up so much due to those RMDs. So that's kind of like the big point of this video, is to show you that yes, we can keep our taxes lower here. We can pay lower premiums on our Medicare or our health insurance at this point, but at what cost? Because if we do that now, we might be giving up a lot of money down the road because we didn't pay attention or plan that far ahead or run projections. So let's look at this. What if we said we're going to start conversions here in 2025 and we're going to do them until Bob turns 65. So we can see that we're going to start Roth conversions here in 2025 and we're going to stop doing them whenever Bob turns 65 once Medicare turns on. And this is also likely whenever they would not have as much money available to them in the brokerage account. So we're going to actually just say, what if we converted up to that 10% bracket here? Let's hit refresh and see what that populates. So you can barely see it, but right here, there's a little green sliver that fills up to that blue line, which is the top of the 10% bracket. So that includes the first 10% bracket, but also the standard deduction, which is what's being included here as well. And so just doing that alone for those 5 to 6 years, we can see actually how much they'd be converting. So 41,000, 43, 46, 49, 52, and so forth. That's how much they would be converting until Bob gets to 65. So they have about 5 years worth of conversions. And just by doing that, you can see their tax-free account, which was zero to begin with, goes up over that period of time and starts making money to nearly $300,000 by the end of that 5-year period. Now, here's the thing. If we look at this, we can see $410,000 of after-tax benefits are being created. So this is in tax-adjusted ending assets. So it's not necessarily $410,000 more dollars are to your name on your balance sheet. What this is saying is if we factor in taxes and how much tax would have to be taken out of your tax-deferred accounts, even if it is on paper a higher number, it's still net positive for you to do these Roth conversions, and it actually is about $410,000 of benefit. That's just up to the 10% bracket of doing Roth conversions for just those 5 years. Now let's keep going and see, what about the 12% bracket? $669,000 is the benefit by converting up to the 12%. Now let's keep going again and go to the 22% there, and so slightly more, so about $10,000 more. So there is kind of like a break-even point here of whether or not we pay 12% or 22%. That's the current tax rates that we're looking at. So that's something you want to analyze year to year once you get to that point. So it doesn't continue going up. There is some sort of diminishing return to converting more and more. But one thing I wanted to show you really fast, if I push this back to 12%, you can still see they might end up a little bit in these IRMA surcharge brackets. So you can see right here, the light blue is the previous original that we hadn't done any Roth conversions under. This darker blue section down below, they probably wouldn't cross over into the first IRMA threshold until like 81. So they have I guess less years if they do Roth conversions at 12% of Medicare premiums being increased through IRMA. But if they do the 22% bracket, there's slightly less after-tax or tax-adjusted ending balance. But you can see that if they want to be completely out of IRMA forever, they can just do a 22% conversion on those 5 years, and they don't pay any ever. So that's something that is a personal decision. And hey, is a couple extra $1,000 of benefit worth it to pay more tax now? Obviously, you got to think about future tax rates and what they might end up being. But anyway, I think I want to stick in just that 12% bracket, at least like as a firm number, and we can evaluate 22% every single year after that. But here's what we're going to do. I'm going to show you this. So right now you're probably thinking, Jacob, but this doesn't account for the actual higher premiums that you've got to pay today on the health insurance that you're having to do in private insurance. So you're not getting the ACAs anymore by doing this 12% Roth conversion amount. So that's the benefit, assuming the same premiums on your health insurance. But if we go back, that's why I wanted to add in this here. If we add another, what was it, $13,200 to our goals section. So what this does is this puts us at about $18,000 or so combined for the year now between 2025 and 65. For Bob and Sue's health insurance. So if we add up these two numbers, it's about $4,800 for them currently with the ACA subsidies. But if we take those away because we're doing Roth conversions, then they would add in this additional $13,200 equals about $18,000 in premiums versus only $4,800. So the big increase in premiums. And so by doing this, they're going to end up paying about $66,000 more over the next 5 years for their health insurance premiums until they get to Medicare, which is not a small amount of money. But what I want to do is compare that to what if we did that anyway and we got the benefits of the Roth conversions over our lifetimes? So if we come back to the retirement tab, we can see that based on all these different things, let's assume this. So the new chance of success is still 100%. Our dollar amount went down slightly because of those higher premiums that were now built into the original plan. But if we factor in the tax situation here and we look back at this, these numbers are going to be down just a touch, right, from what we just showed you. But there's still a big benefit to doing the Roth conversions. So again, it's not quite $600,000 or $700,000, but it is $500,000 more in tax-adjusted ending assets. So this number includes taxes being saved, like in actual dollars, but also it assumes tax-free growth on the money that's in that Roth IRA moving forward as well. So you can see that really the difference here in the question is between $559,000 of long-term lifetime tax savings and benefits compared to $66,000 of premiums today. So that's the cost, that's the trade-off. So that's really what we're evaluating here is it worth it for you to pay less premiums today, save $66,000 today over the next 5 years, but ultimately give up $500,000 or more in the future? That's the question that you should be trying to answer and figure out, not just looking at your ACA subsidies or your Medicare or health insurance premiums in a silo. Now, some of you might be also thinking, Jacob, what if we just got the ACA subsidies now and we actually delayed the Roth conversions until they were 65 to 70? So we just pushed back the Roth conversion window from 60 to 65 to 65 to 70 so that they could still qualify for the ACA subsidies, get that $66,000 and keep that in their pocket. What's the pro and what's the con? Well, a couple things here. Number one is if we do it that way, they're not going to have any after-tax money to pay taxes with on the conversion. So they would be spending all of their brokerage account over that 5-year period, which we saw earlier. And so they would only have money in their IRAs to live on, but also to pay taxes with. So if you know anything about Roth conversions, the best way to pay taxes on a Roth conversion is with outside money that you're not including in the conversion. So for example, you wouldn't want to have a $100,000 conversion that you withhold 20% of, and then only $80,000 is going to the Roth. You would actually want to have that $20,000 for the taxes come from cash or somewhere else so that you can have $100,000 go from an IRA over into the Roth IRA. So that's something that's important to pay attention to. But also, in my opinion, the biggest factor here is going to be the time component. Whenever you take 5 years away from the growth in the Roth, you're going to be cutting back on how much benefit it has, because really the biggest benefit of a tax-free account like a Roth IRA is the amount of time that the money can be invested there. So let's look at this. What if we actually pushed it back? So remember this number, $559,000. That was how much benefit it was whenever we had the higher premiums for the ACAs not being there because we increased our income due to the Roth conversions. And then we converted every single year up to that 12% bracket. So that was the benefit. Now, what if we did it this way? What if we said instead of conversions in 2025, what if we started in 2030? So that's whenever Bob would be 65. And then we also did it until he was Bob's age of 70. So about a 5-year period as well. So what we're going to do is we're going to hit refresh, and this number is going to be wrong, okay? Number one, you can see a huge difference there. But what we're going to do is we're going to go back and make this truly accurate by saying we're not going to have any extra premium, so we're qualifying for these again. So I'm going to back this out. We're going to go there. I'm going to go back to tax, and now we can see a true number. That's it. So with the ACA subsidies back on the table, they're qualifying for those lower premiums. We're pushing the Roth conversions by 5 years. What we've got is a big difference in total tax-adjusted ending balance, or total tax savings when we factor in all the different components of this, between $500 plus $550,000 to $170-ish thousand. You're looking at about $400,000 of difference there. That's the difference that 5-year window can make. I know it sounds crazy and it seems kind of out of reach in terms of how possible that is, but that's what that 5-year window can do in terms of tax-free growth in your Roth. And one of the big reasons for this is going to be actually how much you can convert, because again, you can see that because we have Social Security turning on here at 67, because we have only IRAs to actually pull from, because our taxable account balance, you can see under this current scenario, it gets dwindled down because we use that to live on tax-free. Now our only source of income is our tax-deferred money, and we're doing Roth conversions. If we fill up that 12% bracket, well, then we're not going to be able to convert as much money every single year, which is why you're not seeing as much Roth benefit or tax-free money over time. Maybe we can actually increase this to the 22% bracket. I'm curious if there's a big increase or benefit there. Not quite a ton. So $229,000 versus $500 plus $1,000. Again, that $500,000 wins, but you would be able to convert a little bit more money over that period of time because you've increased the bracket to the 22%. So all that to say, here's the big takeaway. Tax planning is just not about minimizing 1 year's taxes alone. It's about minimizing your taxes over your lifetime. And sometimes that means you've got to be willing to let go of the short-term wins like ACA subsidies to actually secure the long-term benefits of lower taxes throughout your lifetime. So what should you do if you're in this window of your gap years where you have the opportunities to do these Roth conversions and other tax planning things? Well, the first thing is to build a multi-year tax projection, you've got to look at your income, your projected RMDs, your Social Security timing, and figure out how that plays into your overall decisions. Second, you've got to run a Roth conversion analysis to see what marginal tax rate you'd be in right now today, compare that to what your tax bracket might be in the future. If you're at 12 or 22% today and might be at 32% later, well, that's a pretty good sign that Roth conversions might be a good idea, at least at this point. And I know that all of this can get pretty technical pretty fast. So if you're looking for a partner, like someone to help you make all these decisions and help map things out from taxes to healthcare and investments and Social Security, you can schedule a free intro call with me using the link down in the description below, and I'd be happy to have a conversation with you. Thanks for watching, and I'll see you in the next video.